Are you feeling trapped by your credit acceptance car loan? You're not alone. Every year, thousands of drivers find themselves struggling with the weight of car payments that just don't seem to fit into their financial landscape anymore. Whether it's due to changing financial circumstances, an interest rate that feels unsustainable, or simply the desire to free up some monthly cash, the question on many minds is, how can I get out of my credit acceptance car loan? Welcome to my comprehensive guide on YouTube, where I dive deep into the world of car loans and explore the most effective strategies to navigate your way out of a credit acceptance car loan. With an increasing number of borrowers seeking relief from their financial burdens, I've gathered the most pressing questions from users just like you and are here to provide clear, actionable answers. Method 1. Pay off the car. Paying off your car loan early can be a financially liberating move, allowing you to eliminate monthly payments and save on interest. However, it's important to approach this decision with a clear understanding of your loan terms and your overall financial situation. Look for details about prepayment penalties, the method used to calculate interest, e.g., simple interest versus precomputed interest, and how your lender applies extra payments. Locate your original loan documents and review the terms related to early payoff. If anything is unclear, or if you can't find your documents, call your lender to ask about the implications of paying off your loan early. Calculate the financial impact. Paying off your car loan early can save you money and interest, but it's important to calculate exactly how much you'll save and weigh this against any prepayment penalties or other financial considerations. Ask your lender for a payoff quote, which will tell you exactly how much you need to pay to settle your loan. Compare the amount of interest you would pay over the remainder of your loan term against the interest you'll save by paying off early. If your loan includes prepayment penalties, factor these costs into your calculations to ensure that paying off early still makes financial sense. Assess your financial situation. Before proceeding with an early payoff, assess your overall financial health. Ensure that using your savings or other funds to pay off your car loan won't leave you in a precarious position in case of unexpected expenses. Ensure you have enough in your emergency fund, typically 3 to 6 months worth of living expenses, after you would pay off the loan. If you have higher interest debt, like credit card debt, it might be more beneficial to pay that off first. Compare the potential savings from paying off your loan early with the returns you could expect from investing that money instead. Method 2. Make the payment. Once you've decided that paying off your car loan is the right move, it's time to arrange the payment. When making your payment, ensure it's clear that the extra funds should go towards paying down the principal balance of your loan. Follow your lender's instructions for making a payoff payment. Some may require a cashier's check or a direct transfer. After making the payment, ask for a confirmation that your loan has been paid in full. You should also receive a title release or a statement indicating that the lien on your vehicle has been removed. After your car loan is paid off, there are a few administrative tasks to take care of. After paying off your car loan, contact your insurance company to remove the lender from your policy and consider if you need to adjust your coverage. Ensure you receive the car title, now free of liens, from your lender. With your car loan paid off, reassess your budget and decide how to allocate the funds that were previously going towards your car payment. Method 3. Make extra payments. Making extra payments on your car loan can significantly reduce the time it takes to pay off your debt and the total amount of interest you pay. When you make an extra payment, it's typically applied directly to the principal balance of the loan, which reduces the amount on which future interest is calculated. Confirm with your lender how extra payments are handled. You want to ensure that any extra payments are applied to the principal and not just set aside for future payments. When you make an extra payment, clearly indicate that you want the funds to be applied to the principal. This might require you to follow a specific process or fill out a form. Plan your extra payments. Decide on a strategy for making extra payments that aligns with your financial situation. You can make a large lump sum payment, add an extra amount to your monthly payments, or pay half your monthly payment every 2 weeks. Bi-weekly payments. Review your monthly budget to determine how much extra you can afford to pay. Even small additional amounts can make a difference over time. Decide if you'll make extra payments monthly, quarterly, or as a one-time lump sum. If possible, set up automatic extra payments to ensure consistency and avoid the temptation to skip a month. Calculate the benefits. Use an online car loan calculator to understand how making extra payments will affect your loan. You can see how much interest you'll save and how much sooner you can pay off the loan. Consider your financial goals. While making extra payments on your car loan can be beneficial, it's important to consider your broader financial goals and obligations. If you have other debts with higher interest rates, it may be more beneficial to pay those off first. Ensure you have a solid emergency fund in place before allocating extra funds to your car loan. Consider whether investing the extra money could yield a higher return than the interest you're paying on your car loan. Communicate with your lender. Maintain open communication with your lender throughout the process of making extra payments. Keep records of any communication with your lender regarding extra payments. Regularly check your loan statement to ensure that your extra payments are being applied correctly. Periodically verify your remaining loan balance with your lender to ensure that all payments have been accounted for properly. Your financial situation can change, so be prepared to adjust your extra payment plan accordingly. Reassess your extra payment strategy periodically to ensure it still fits your financial situation. If you encounter financial challenges, remember that extra payments are not obligatory, and you can adjust the amounts or pause them as needed. Method 4. Refinance your car loan. Refinancing your car loan involves replacing your current loan with a new one, usually with different terms, to improve your financial situation. This can lead to lower monthly payments, a reduced interest rate, or a change in the loan term. If market interest rates have decreased since you took out your original loan, refinancing could secure you a lower rate. A higher credit score can qualify you for better loan terms than you had initially. Extending the term of your loan through refinancing can lower your monthly payments, though it may increase the total interest paid over the life of the loan. Lenders typically prefer a loan-to-value (LTV) ratio of 80% or less. If your car is worth more than you owe, refinancing is more feasible. Steps to refinance your car loan. 1. Check your credit score. Before applying for refinancing, know your credit score. A higher score increases your chances of getting a better rate. You can obtain your credit report for free from the major credit bureaus. 2. Gather necessary documents. Prepare the documents you'll need for the refinancing application. These typically include proof of income, proof of insurance, your current loan details, and information about your vehicle. 3. Shop around for the best rates. Don't settle for the first refinancing offer. Compare rates from multiple lenders, including banks, credit unions, and online lenders. Use online calculators to estimate your new payments and total interest costs. 4. Consider the loan term. Decide if you want to shorten your loan term to pay off your car faster and save on interest, or extend it to reduce your monthly payments. Be mindful that extending the term can result in paying more interest over time. 5. Apply for refinancing. Once you've chosen a lender, complete the application process. This will likely involve a hard credit check, which can temporarily impact your credit score. 6. Evaluate the offer. Carefully review the terms of the refinancing offer. Pay attention to the interest rate, monthly payment, loan term, and any fees or penalties. 7. Finalize the refinance. If you decide to proceed, finalize the refinancing by signing the loan agreement. Your new lender will pay off your existing loan, and you'll start making payments to the new lender under the terms of your new loan. Method 5. Trade the car in for another vehicle. Trading in your car for another vehicle can be a convenient way to change your mode of transportation while also dealing with an existing car loan. When you trade in a car with an outstanding loan, the dealer will take over the loan and pay it off as part of the transaction. The trade-in value of your current car will then be applied to the purchase of your new vehicle. If your car is worth more than the remaining loan balance, the extra money can be used as a down payment on the new car. If it's worth less, you have what's called negative equity, and you'll need to deal with that as part of the trade-in process. Steps to trade in your car. 1. Determine your car's trade-in value. Before heading to the dealership, research your car's current trade-in value. Use online valuation tools from websites like Kelley Blue Book or Edmunds, and consider getting quotes from multiple dealerships or used car retailers. 2. Know your loan payoff amount. Contact your lender to get the payoff amount for your car loan. This is the total amount you need to pay to fully satisfy the loan, and it may differ from your current balance due to interest and fees. 3. Calculate equity or negative equity. Subtract the loan payoff amount from your car's trade-in value to determine if you have equity or negative equity. Positive equity means your car is worth more than the loan balance, while negative equity means you owe more than the car's worth. 4. Explore your options. If you have positive equity, you can proceed with the trade-in and apply the extra value toward your new vehicle. If you have negative equity, you'll need to decide whether to pay the difference out of pocket, roll the negative equity into your new loan, or wait until you have positive equity to trade in. 5. Negotiate the trade-in offer. When you receive a trade-in offer from a dealer, negotiate to get the best possible value for your car. Be prepared to walk away if the offer is too low, and don't hesitate to show quotes from other dealerships or valuation tools as leverage. 6. Finalize the trade-in and new purchase. Once you've agreed on a trade-in value, the dealership will handle the paperwork to pay off your existing loan and apply the trade-in value to your new vehicle. Review all the documents carefully to ensure the agreed-upon terms are accurately reflected. Method 6. Voluntarily surrender the vehicle. Voluntarily surrendering your vehicle, also known as a voluntary repossession, is an option to consider when you're unable to continue making payments on your car loan and other solutions like refinancing or selling the car privately aren't viable. This process involves willingly returning the vehicle to your lender or finance company. While it can alleviate the immediate financial burden of monthly payments, it's important to understand the implications and steps involved. Voluntary surrender should be seen as a last resort due to its potential negative impact on your credit score. It is, however, slightly less damaging than involuntary repossession because it demonstrates a proactive approach to resolving the debt. The surrender will be noted on your credit report and can affect your ability to obtain loans in the future. Steps to voluntarily surrender your vehicle. 1. Communicate with your lender. Before deciding to surrender your vehicle, contact your lender to discuss your situation. They may offer alternatives that you hadn't considered. If surrender still seems like the best option, ask about the process and any specific requirements they have. 2. Understand the financial implications. Even after you surrender the vehicle, you might still owe money. This happens if the car sells for less than the remaining balance on your loan, a situation known as a deficiency balance. Your lender can demand payment of this balance. Be sure to ask your lender how they handle deficiency balances post-surrender. 3. Prepare the vehicle. Remove all personal belongings from the car and gather all related items, such as keys, manuals, and service records. Cleaning the vehicle isn't necessary, but presenting it in a decent condition might help fetch a better price at auction, potentially reducing any deficiency balance. 4. Return the vehicle. Arrange with your lender where and when to drop off the vehicle. Ensure you get a receipt or document proving you surrender the vehicle, as this can protect you from any claims of non-return or abandonment. 5. Follow up on the sale of the vehicle. Your lender will sell the vehicle, typically at an auction, to recoup as much of the loan balance as possible. Ask for information on the sale, including the sale price and how it affects your loan balance. If there's a deficiency balance, discuss with your lender how it will be handled. After surrendering your vehicle, if there's a remaining balance after the sale, consider your options for paying it off. Your lender may offer a payment plan or settlement. Ignoring this balance can lead to further financial complications, including collections and additional hits to your credit score. Repairing your credit. A voluntary surrender will impact your credit score, so take steps to rebuild it. This includes paying all other bills on time, reducing outstanding debt, and possibly using a secured credit card responsibly to add positive activity to your credit report. Consider transportation alternatives. Without your vehicle, you'll need to arrange alternative transportation. Look into public transportation, carpooling, or affordable vehicle rental options until you're in a position to purchase another vehicle. Method 7. Loan modification or negotiation. Loan modification or negotiation involves altering the terms of your existing car loan to make the payments more manageable. This can be a viable option if you're struggling to keep up with payments due to financial hardship but want to avoid repossession or damaging your credit score. Negotiation, on the other hand, might involve temporary adjustments or settling the debt for less than what's owed. Both options require communication with your lender to agree on new, more favorable loan terms. Steps for loan modification or negotiation. 1. Assess your financial situation. Before reaching out to your lender, have a clear understanding of your financial situation. Prepare a detailed budget that includes your income, expenses, and debts to demonstrate your need for modification. 2. Contact your lender. Reach out to your lender as soon as you realize you're having trouble making payments. Lenders are often more receptive to working with borrowers who are proactive in addressing their financial difficulties. 3. Explain your hardship. Be honest and transparent about the financial challenges you're facing. Whether it's due to job loss, medical expenses, or another significant life event, providing context can help the lender understand your situation. 4. Request a loan modification or negotiation. Ask your lender what options are available for modifying or renegotiating your loan. Possible modifications could include reducing the interest rate. Lowering the rate can decrease your monthly payments and the total interest paid over the life of the loan. Extending the loan term. Spreading the payments over a longer period can reduce your monthly payments but may increase the total interest paid. Deferring payments. Some lenders may allow you to skip a few payments and add them to the end of the loan term. Reducing the principal balance. Although less common, some lenders may agree to forgive a portion of the principal. 5. Provide documentation. Your lender will likely require documentation of your financial hardship. This may include recent pay stubs, tax returns, bank statements, and a hardship letter explaining your situation. 6. Review the terms. If your lender offers a loan modification or negotiation, carefully review the terms to ensure they are sustainable for your financial situation. Pay particular attention to how the changes will affect your monthly payments and the total cost of the loan. 7. Get everything in writing. Once you agree to new loan terms, ensure that all changes are documented in writing. This agreement should detail the modified terms, the duration of the modification, and any impact on the total amount owed. 8. Keep up with payments. After your loan has been modified, it's crucial to keep up with the new payment schedule. Defaulting on the modified loan could lead to repossession and further damage to your credit score. In conclusion, navigating your way out of a credit acceptance car loan, or any car loan for that matter, might seem like a daunting journey at first. However, with the right knowledge and strategies at your disposal, it's a journey that can lead to financial freedom and peace of mind. Each option comes with its own set of considerations, but the goal remains the same: to find a solution that aligns with your financial situation and goals.